to our multi-asset quarterly update. It's 30 June, the second quarter of 2020, and there really is once more a lot to talk about. It's certainly been a year of extremes. The quarterly one update, we spoke about the COVID crash, and this quarter has certainly been the COVID bounce. COVID, however, still dominates the headlines in a negative way. Globally, we're approaching 12 million cases of COVID infections. To contrast that with Q1 update, we were talking about a number like 750,000. So we really can see how the number of cases has exploded globally. South Africa has seen a similar ramp up, if probably not more exaggerated. Partly as a function of a really hard lockdown in the beginning of the COVID outbreak, which constrained the spread of the disease, and now we're starting to see it pick up more and more, with Gauteng just recently overtaking the Western Cape as the epicenter. So really, COVID still dominating headlines, and I believe it will do so for the foreseeable future. However, notwithstanding the COVID domination, we've seen capital markets bounce. We've seen global equities bounce. We've seen a lot of risk on appetite as emerging market equities have rallied, being the major beneficiary or the major winner of the optimism in the markets over the last 3 months. Not to mention SA equities in rands really having a stellar quarter. SA property turned positive for the first time in a long time, which was really encouraging, partly potentially as a function of it being, really have sold off so aggressively that perhaps it turned. Turning to South Africa, what we've seen is the repo rate being cut twice, 100 basis points and then a further 50 basis points over the quarter. We're seeing a repo rate at an all-time lows, historic lows of 3.75%. And a prime lending rate of 7.25%. The exact words in terms of the repo cuts were that they weren't intended to be stimulus, but rather relief for consumers, for what is very strained South African consumer, job losses on the horizon, and so forth. Following some of the repo cuts, there was a supplementary budget put forward by our Minister of Finance, with a big focus on SA's debt challenge ahead. They have promised to come out with more details around how we're going to tackle our debt challenges. However, they've given us a passive and an active scenario, and we are in pretty poor shape in terms of our debt to GDP numbers and a whole lot of other debt numbers. So, it's on the agenda, and hopefully it can move beyond talk, and we can action some real reform to address the debt challenge that the South African government and South Africa has. Rand has strengthened over the last quarter, primarily as a function of that risk on appetite we were talking about earlier, but not significantly so, by approximately 4% to the US dollar, to the low 17 rands to the dollar is where it closed over the quarter. Not forgetting that we started the beginning of the year in the low 14s, so still a significant rand weakness over the year, but the quarter did see rand strength. What we've seen is really the equity and risk assets bouncing in the last quarter. If we contrast this with the first quarter of really similar quantums, so negative 20% odd for equities in the first quarter, followed by 20% bounce in the second quarter. So high equity funds like our Wealth Accumulation Fund was the beneficiary of risk on and equity markets and property markets running. And if you look at the attribution there, you'll see that the vast majority of return generation over the last quarter was driven through equities, both local and global, and property. But South African equity really did run hard after what was a very sharp short sell-off that existed in the market. Bonds had an interesting quarter. The nominal bonds had a record May, one of the largest bounces since 2008 financial crisis. Our bond index jumped up 7% in May. So really strong returns from the nominal bond market. And that was followed by a marginally negative return in the month of June. So, really the story here is risk on optimism flooding back into the markets as governments have relaxed on their stringent lockdowns, and a degree of optimism creeping into capital markets over the last quarter. What is interesting is a reversal in the trend from the first quarter, where foreign bonds, most notably the global government bond exposure we have, negative in rands over the last quarter, of course positive in dollars because of rand strength, but where we saw very strong positive returns in rands over the first quarter from our government bond exposure, global government bond exposure, we now see negative. But the reality is that it's exactly what we want to see out of a diversified portfolio, is asset classes showing levels of decorrelation, which is fantastic to see. So really a good quarter and a welcome relief from the hard sell-off in the first quarter, up 17%, with the clear winners being our risk assets in our portfolio, making up 82.5% of this portfolio. So it's not surprising this portfolio has jumped to the extent it has. When we look at our low equity portfolio, our stable income portfolio, we see equity again being the major driver of return, but property once again a welcome relief in terms of that return. And of course, because we've got a larger exposure to bonds in this portfolio at an attribution level, it has a far more meaningful contribution to returns than it would in a high equity portfolio. So following local equity at 27.5% weight, local bonds contributed a lot, the second largest return on a relative basis in the portfolio. So good to see again the diversification benefits of holding multiple asset classes in the portfolio. The foreign bonds, once again, same story, negative. However, considering that they're mostly used for capital protection and diversification, again, not a bad thing to see levels of negative correlation pulling through the asset class returns. What we want to do to make this slightly different to just a general update, and to try and keep it short, it's just one message to leave the investors with, and to leave you as investors with. And our message here is time in the market. In our Q1 update, we spoke a lot about the importance of holding equities in a portfolio because it was a growth driver and an inflationary protection driver over the long term. So really what we were able to glean from the numbers when we looked at them was SA equity as measured by the top 50 index, which is part of both stable income and wealth accumulation, having a fantastic Q2 at least, 23% return. However, when we look at the CISA stats, this is work produced by Rand Merchant Investment Managers. We see 5.2 billion rands worth of disinvestments coming out of the SA equity markets in Q1. So really, those knee-jerk reactions to disinvest from equities when markets are crashing often happens at exactly the wrong time. And what we see time and time again is often the best month immediately follows the worst month. So, we wanted to stress the importance of time in the market, of understanding time horizons. A high equity wealth accumulation fund has at least a 5-year time horizon. The stable income, which is a low equity fund, even a low equity and low risk fund has a 3-year time horizon. So to consider the implications of disinvesting at exactly the wrong time. And what we see here is that South African investors are certainly not perfect, as they disinvested from 5.2 billion rands out of the SA equity, CISA general equity category in Q1, only to have SA equity rally by 23% in Q2, leaving approximately R1 billion of upside on the table is about what that looks at. So you're probably sitting there thinking, yeah, everyone else has done that. We got it right. We got it early. And what we wanted to show was how difficult it is to time the market. So we played out a very simple scenario here. And what we looked at was 100 Rand invested on the 1st of January, 100 Rand invested on the 1st of January, 2020, invested in equity. You were going along with the equity markets, a small down, 2% down in Jan. Feb, things started to get a little bit hairy, and you were fortunate enough on the light blue line to disinvest from the markets before the really big crash when the COVID impact happened in in March. You, the blue line, and you end with 90.88 Rand. The red line, so that we calling the good luck investor, he timed the big monthly sell-off perfectly and got his money out of the market, but has sat in cash ever since on the sidelines, waiting to reinvest. The bad luck investor is someone who disinvested their money at the end of March, at the end of the sell-off, and what we see is that investor is left with around 78.99 Rand. So they moved into cash and missed the rally of 23%. What's really interesting to note is that in this scenario, whether you were a good luck investor or a bad luck investor, you would have been better off sitting on your hands and just riding through the volatility, staying invested in SA equities, where if you started the year with 100 Rand in this illustrative example, you would have ended at 95.81 Rand. So notwithstanding your good luck and missing the worst month of the year during the COVID crash, you would have still been worse off than had you just stayed invested in equities throughout the first 6 months of the year. So really, we want to drill home this kind of timeless message. It also talks into some stories of strategic asset allocation that we talk about, but really time in the market is rewarded, even over a short time horizon like this. So that wraps up our quarterly update. I hope you could take something away from it. If you have any questions, please give us a shout, and we're more than welcome to answer any questions in detail. As I mentioned, this is intended to be very brief updates of our quarterly update. So just an overview of the asset classes represented and the risk and returns, and then of course how we at CoreShares approach our investment problem through asset allocation, strategic, mostly or entirely strategic. That talks to time in the market, that talks to not trying to time the market, rules-based index allocations, being well diversified, systematic allocation to factors, and keeping fees low. What we ignore is the speculative, the uncontrollables, macro events, etc., etc. So thank you so much for your time. I hope you enjoyed it, and have a great day further.